In the meantime, though, we have some news just out. JPMorgan out this morning with Jamie Dimon's annual letter, and Leslie Picker has that letter. Leslie.
Hey, Andrew, good morning. A wide-ranging 50-page annual letter from Chairman and CEO Jamie Dimon this morning on AI. He's saying that investment in AI is not a speculative bubble, and he said, quote, in the long run, it will have a huge positive impact on productivity. He's saying AI will definitely create and eliminate some jobs, and it, quote, will also introduce serious new risks from deep fakes and misinformation to cybersecurity vulnerabilities. On private credit, Dimon noting that actual losses right now are already a little higher than they should be relative to the environment. And he writes, quote, by and large, private credit does not tend to have great transparency or rigorous valuation marks on their loans. He said at some point insurance regulators will insist on more rigorous ratings or markdowns, and said if anything goes wrong, retail investors will seek remedy in courts. However, Dimon said private credit is probably not a systemic risk. Dimon has a long section in the letter, guys, on bank regulations, and said their initial reactions to the new proposals that came out a couple weeks ago were mixed, with some aspects that he thinks are, quote, nonsensical. He said JPMorgan would have to hold as much as 50% more capital on the majority of their loans compared with mid-sized peers if these proposals were passed. And then lastly, in terms of the broader economy, Dimon saying it continues to be resilient while noting some weakness, some recent weakening of the consumer. He reiterated what he told us last month in Miami, that the, quote, skunk at the party, and it could happen in 2026, he said, would be inflation slowly going up. He said the Iran war could drive up inflation and interest rates, and warned of the potential for further oil and commodity shocks from here, guys.
Leslie, what was your sense? I mean, the interesting part to me about that letter was the skunk at the party line, which you pulled out, and the private credit piece more than anything else. Having said that, I did think that his commentary around private credit, while not arguing that it was systemic, raised some questions just about the marks piece of all of this. And as you think about sort of legislation or regulations, about how people are going to think about some of these marks and even the way insurance companies are marking some of this stuff.
That's what I thought was really interesting, too, because we've heard him talk a lot about private credit, but honing in specifically on this transparency issue, on the marks issue, that felt pretty new to me. And then also just the regulatory implications of all of this, specifically the insurance regulators, which a lot of these, of course, are in insurance vehicles. You've got Athene, for example, which is tied to Apollo and so forth. And then the retail investor aspect as well, seeking remedy in courts. That kind of echoes what we heard from Lloyd Blankfein, this idea that, you know, all is fine if you sell it to institutions, but once it starts going in a big way into retail portfolios, if anything goes wrong, it could be a big reputational risk.
Well, and we've watched it, obviously, with Blue Owl last week, which continues to hemorrhage, both in terms of its stock price itself and then all the folks who seem to want to get out of those vehicles. The question is if there's a reason for anybody to get into those vehicles in this moment to take some of the pressure off of them. And if they don't, what happens? I mean, the sort of irony is we haven't reached a point yet in the private credit land where all these software companies, which everybody's so worried about, have gone belly up and therefore have hit the credit market yet, right? So it's all in anticipation of something.
Yeah, and that's what's kind of interesting, because in a few of these vehicles, and interestingly, despite all of the redemption requests in those two Blue Owl funds last week, they did still see inflows. And of course, they capped the redemption. So combined with the gating that they chose to do and a little bit of inflows, they didn't have massive outflows. Now, some of them, they just didn't allow the outflows to happen. As a result, the fund size stayed basically the same, which means that, they didn't forego much in the way of fees. And the question, I think, is a good one, Andrew, is who's going to be, the marginal inflows from here, if not for retail? Is institutional tapped out? Are they still even interested, given all the negative headlines?
Leslie, thank you for bringing us that letter. It's a fascinating one. It is long, it is lengthy, but there's a whole bunch of pieces of it that I think are going to be some big reading for folks on Wall Street this morning. Thanks.